Here we outline what we believe are 5 benefits of being of having a CMBS loan or buying into a CMBS bond. And, as I get to number 2, that's when I'm actually going to start sharing some things with you about how things have changed in our world. But number 1, as I just talked about, one of the main benefits of buying into a CMBS bond is just that you have a greater range of risk and return scenarios to pick from. You can look at that bond waterfall and figure out, okay, based on the amount of risk that I want to take on, where do I want to buy into the bond? So you've got a greater selection of risk and return scenarios. The second one is liquidity. And that's a big one for us because for a very long time, CMBS we were always considered a very liquid market. Insurance companies would buy our bonds because that was a good way for them to get exposure to the commercial real estate sector by buying our bonds. And if they ever needed to reduce that exposure, they felt like they could easily trade our bonds back out in the market. Well, recently we just figured out it doesn't always work like that. You can have a number of investors that exit the market, that run to the sidelines, and it can make it very hard for trading to continue to occur. And that's the kind of thing that we're going through right now. We're actually realizing that the CMBS market is not nearly as liquid as we thought it was, and it's not as protected from drying up as we thought it was. Portfolio diversification. When I showed you that bond waterfall, and as you recall, I said there's thousands of loans that can go into these pools. Well, these loans may be all over the country. It may be an apartment building that I did in Greensboro, North Carolina, along with an office building in Raleigh, North Carolina, but it could be also mixed with an apartment building in San Francisco, California. It could be a shopping center out of Arizona. So you just get very good portfolio diversification because you've got a lot of different geographies and a lot of different property types that are mixed into that bond offering. It's cross-collateralized, obviously, because you got various types of properties that are in there. But this is a big one. It's call protected. Residential real estate loans, can typically be prepaid. There's ways they normally structure very soft prepayment penalties, and you can get out of those. CMBS loans are completely different. You would have to literally kill your mother to get out of one of our loans, I tell you. It's very inflexible, okay? So it really works against you if you're a developer, because if you're a developer and you own a shopping center, and I'm a tenant in your shopping center, and I come to you and say, hey, Sheila, I want some more space in your shopping center. Will you knock out a wall for me, and I'm going to rent more space from you? Well, if you have a CMBS loan with one of our guys, you're going to try to call us up to get that approved. They don't even really staff their customer service to take calls. It's not set up that way. It's only set up. The servicers are only set up to take money. And they take that money in, and then they push it down to the investors. So it's very, post-closing, it's not very friendly at all. Now, if you had a loan with Kevin, all you got to do is call Kevin up down to the office. Kevin's going to pull your loan file, and he's going to figure out, he's going to ask you some questions and figure out where you are, and he's probably going to make the approval for you to go ahead and expand the space so that you can bring in some additional income. So that's one of the things you always have to keep in consideration with CMBS loans. They are very inflexible, but there's a reason why they're inflexible. These bond investors buy into the CMBS bond thinking that they're going to get principal and interest payments for about 10 years. They don't want that interrupted at all. Insurance companies have billions of dollars that they have to place out in the market. They don't want to have to keep moving their money in and out of something. And that's what occurs when these loans get prepaid. So they really try to protect the loans from being prepaid so that the bonds are not called early. And another way that they do that is through a process that we call defeasance. Within that pool, you've got 1,000 loans in the pool. Okay, all of a sudden Christopher calls me up. He wants to refinance. See, he says, hey, I've got to get out of this deal. I just have to do it. I got to get it done. Well, there is a way to do it, and it's called defeasance. And what we would do is we would have Christopher buy a package of treasury securities. His treasury securities would then replace his loan in the pool. And his treasury securities would be designed in a way to generate a principal and interest payment that's similar to what his loan would have generated. Now, defeasance is a very complicated process, and the few words that I said it in, it's a lot more complicated than that, and it costs a lot of money to do it. I had an apartment deal that I was working on last year. It was a refinance, and the gentleman needed to refinance some equity out of the property. He wanted to buy out some of his partners and take control of the property. Well, it was going to cost him $400,000 just to do the defeasance payment. That was just for the defeasance. But for him, it still made sense because he was going to buy his partners out. And if you recall what Kevin stated about, it takes a little bit of salesman in order to get these deals done. Well, it took a lot of selling to get this guy to spend $400,000 to do a loan with me. And one of the ways that I was able to do that is I had to keep him focused on what we call your emotional pain. His emotional pain was, I need to buy my partners out. I want to own this property all by myself. So every time he pushed back at me and say, Algenon, I'm not spending that $400,000 to get out of this loan, I would say, Dr. Shadid, think about this. At the end of the loan, at the end of the process, it's all yours. It's your property. No more partners. All the cash flow is yours. So eventually he ended up doing that deal. So he's right. You got to have a little bit of salesman in you if you want to get deals done. What is CMBS role in commercial real estate? One of our biggest roles is you have insurance companies, you have pension funds, you have REITs. They all have capital and they want to place it for long term. CMBS allows that to happen very efficiently. It brings consistent underwriting and efficient pricing to the financing equation. Real estate, have you ever heard real estate's a locally played game? Well, it's the same way when these banks look at these deals. CMBS really changed that because it really standardized the way that we look at these deals because all of these loans are going into a bond offering and being sold off. And then it provides a steady capital source for borrowers. Some borrowers would actually say that it doesn't provide a steady capital source after the last 8 months or so.